Welcome to Build a Better Financial Future, the podcast for first-generation high earners who want to do more with their money. If you're ready to take control of your financial future, you're in the right place. Now, please join your host, Louis Rosa.
Hello, and welcome back to another episode of the Build a Better Financial Future podcast. Thank you all for your patience. I know I've been in a bit of a hiatus. I moved back to the East Coast from Las Vegas, and I also switched firms. So it's been a couple of big changes going on. So now I'm back. I plan on doing the podcast monthly, but during a season, typically from June till about November, one episode per month. And then I go right into the year-end tax season, and then I come back and do another episode once a month from those months from June to the end of the year. So thank you all for tuning in. I appreciate it. Tax planning is a year-round sport. So I wanted to show some of the highlights of the One Big Beautiful Bill Act so that you are aware of the major highlights, things that are very important to most individuals. Now, this is not tax advice. Obviously, this is just for educational and informational purposes only. So make sure to always check in with your CPA or your tax professional before you implement any strategy or do anything that may impact your taxes. But I want you to be aware of certain changes that take effect due to the One Big Beautiful Bill Act, some of which are new in 2026. So now that we're somewhat in the middle of the year, you have a great opportunity to start planning ahead. So some of the things I'm going to talk about in this episode are the child tax credit, the mortgage interest deduction, which is back, the deductions for seniors, the no tax on tips, the no tax on car loan interest, no tax on overtime, state and local tax deductions, qualified business interests, charitable giving, and also some tax favored accounts for newborns. These are some of the major things that I find that most individuals will likely be affected one way or the other. Obviously, it doesn't include it all. This bill was huge. It was almost 1,000 pages. But I think these are the highlights that cover most things that people should know. So, I heard a quote from someone. I don't know who it is, unfortunately, so I can't give them credit. But it says paying taxes isn't voluntary, but overpaying is, which is why I make sure that I point out to you that tax planning is extremely important for individuals to do. And what I mean by that is when you go to your tax professional's office during tax season and you drop a whole bunch of paperwork to them, there's only so much that could be done because it's backward looking. It's like looking in the rearview mirror. Where have you been? Right. So they're just going to do your taxes based on the information you provided. Maybe there are a few things that you could do last minute, like some IRA contributions if you qualify. So some of those, like health savings account and so on, some of those have the ability for you to contribute up to the tax filing deadline. But for the most part, there's not a lot that could be done during tax season for that prior year's return that just passed. So tax planning is looking forward and saying, what can I do now to maximize my basically my tax situation? How do I optimize my taxes? How do I lower taxes? Can I control what tax bracket I go into? What are the consequences of doing certain moves throughout the year? Like something as simple as contributing to your 401k is going to have an impact on your taxes. Should you be doing pre-tax? Should you be doing a Roth option? What happens if you sell some appreciated stock? Can you take advantage of some depreciated stock that you have sold at a loss to offset some gains? These are the kinds of conversations I have with my clients. And I highly recommend that you speak with a financial professional that has a thorough understanding of taxes or can at least coordinate with your tax preparer so that you have the most optimized outcome for you. Speaking of which, I do have the ultimate tax guide for 2026. You can visit buildabetterfinancialfuture.com. It's right on the homepage. Just enter your email address and your first name, and you'll get an email with a link to download it. So it shows beyond what I'll be discussing here today, a lot of the things that you should know, some of the key areas that you can take advantage of things before the year's out so that you have a better outcome in your taxes. So let's get right into it. Before I tell you some of the things in the One Big Beautiful Bill Act, I want to cover just some very basic things that I feel like will be very helpful for you to understand just how taxes work in general. Number one is the difference between a deduction and a credit. You may hear those words thrown around. So, for example, the child tax credit is a dollar for dollar amount that if you qualify, you get that as an actual dollar for dollar amount in your taxes, right? So if you owed $5,200 in taxes and you get a $2,200 child tax credit, that literally lowers the amount you owe down to $3,000, right? It's a dollar for dollar amount. A deduction is different. A deduction, often people think that they're getting something back in their taxes. I hear that people say that a lot, like, oh, I can write this off and get it back in my taxes. Not quite. So the US system currently has 7 tax brackets. They range from 10% to 37%. So it's 10, 12, 22, 24, 32, 35, and 37. And the more money you make, then you're likely to cross into the next bracket. So not all of your income gets taxed at the same rate. So X amount of money, depending on your filing status, gets taxed at 10%. Then every dollar after that gets taxed at the next bracket, which is 12, right? That's called the marginal tax bracket. So if you have an understanding of how those work, you could potentially do things to your benefit. So in this case, a deduction is money that you do not pay taxes on. So it lowers your taxable income. So for example, let's say you have a $1,000 tax deduction and you are already into the 22% tax bracket. So that means that you are not going to pay taxes on that $1,000. So you save 22%, meaning you save $220 in taxes. That's all that means, right? So key differentiation between a credit and a deduction. I think having an understanding of these two will really simplify how you understand taxes, and also understanding the fact that not all of your money gets taxed at the same rate, right? The brackets that we talked about. So the government gives you an option when it comes to deductions. You have the ability to either take a standard amount, which is literally a standard amount that the government provides, as a deductible amount that you can just subtract from your gross income in order to arrive at taxable income. And that depends based on your filing bracket. So since 2025 is the most recent in memory, for married couples filing jointly in 2025, that was $31,500. So a couple filing jointly in 2025, if they don't have itemized deductions, which I'll cover next, means that they can lower their income by $31,500 and not pay taxes on that amount, standard, right? That is actually going up to $32,200 in 2026 for this year. Head of household is $23,625 in 2025, and it's $24,150 in 2026. And then single or married filing separate is $15,750 in 2025 and $16,100 in 2026. So that means if you don't have itemized deductions, which I'll tell you what those are in a bit, you can just take the standard deduction and not pay taxes on that money. So that's great. Now, on the other hand, you may hear itemized deductions. What are those things? So if you have eligible expenses that end up being more than the standard deduction, you can take those and write that number off, which may really benefit you instead of just taking the standard deduction. Some of the most common ones that you may hear of are things like mortgage interest. So you can deduct mortgage interest up until $750,000. If your balance is $750,000 or less, you can deduct the mortgage interest if it was used to buy or build or improve your home. Same thing with when you have home equities lines of credit, that mortgage interest could potentially be deductible as well. Now, what else can you deduct? Things like your property taxes. So if you own a home and you have property taxes, school tax, all those things can be added as an itemized deduction. So if you keep track of, let's say you own a home and you have mortgage interest, you have property taxes, school tax. You also, let's say you live in a state where you pay state income tax or even local. Let's say, in New York, you pay, if you live in the city, you pay New York state tax, you pay New York City tax from your paycheck. You also pay out-of-pocket medical expenses if you exceed over 7.5% of your adjusted gross income. So if you have a year where you had a large expense due to medical expenses that was not covered by insurance, that could potentially be used to be combined as an itemized deduction on your taxes, right? Any amount over 7.5% of your income, right? So if you had $10,000, let's say you had $100,000 in income, anything over 7.5% of your adjusted gross income can be used as a deduction. And also charitable donations. And I'll be talking to you about some of those changes. There have been some changes actually related to mortgage. There's been some changes related to the state and local taxes, and there's been some changes related to charitable deductions. So I want to talk to you about those as well. So think about it that way, right? So usually if you don't own property and you're not charitable and you don't have a lot of out-of-pocket expenses for medical, you're probably going to take the standard deduction. If you're a homeowner, you have charity, you have medical expenses, property tax, and so on, you're likely going to itemize, depending whether that amount ends up being higher than the standard deduction, right? So now you know what a credit is, what a deduction is, and then you know the difference between standard and itemized, right? So having an understanding of those is going to really make this very easy. I know taxes could be complicated, but I'm going to do it as simple as possible so you don't get bored during this podcast. So let's talk about the child tax credit. There's been an increase to $2,200 per child that started in 2025, and that is for children under the age of 17 as of the end of the tax year. So if you have children that you provide more than half the support and they live with you, you could get that $2,200 child tax credit, right? So that could be a pretty hefty amount, especially if you have more than one child. Now, one thing that people don't necessarily realize, and I always tell people to be on the lookout for this, is that at some point when that child goes over the age of 17, the child tax credit drops from $2,200 down to $500. And that is a significant increase, especially if you have multiple children and you're used to getting that money. So here comes one planning opportunity. If your child already turned 17 this year, or is going to be 17 or older this year, then you already know that your child tax credit is going to be reduced. So you have to look at your taxes and say, hey, am I still withholding enough from my paycheck because now I don't have this credit anymore, or I don't have as much of that credit anymore? Should I make any changes? Should I contribute more to my retirement account or withhold more from my paycheck or anything like that, right? Now, there are some income limitations, so it starts phasing out after $200,000. So most people that make less than $200,000, if they're single or head of household, or $400,000 if they're married filing jointly, they can get the full credit. It starts phasing out after that, right? So if you're single or head of household, you make over $200,000, or if you're married filing jointly and you make over $400,000, then that child tax credit starts going low. Now, I talked about salt. I always joke about this, right? For my people that like tostones out there, the mashed plantains, I always say I like to put salt in my tostones. So that's a short acronym for state and local taxes. So if you live in a state where there is state income tax, like New York, California, before 2018, when the Tax Cuts and Jobs Act came out, you were able to deduct all of your state and local taxes that you pay. So that includes property taxes. In some states, let's say like Florida, Texas, or Nevada, right, you can deduct some of your sales tax instead. And then if you have the property taxes for the home, and then local taxes, let's say New York City, right, that has locality, you can lump all those things and deduct them before the Tax Cuts and Jobs Act. That lowered it, actually capped it at $10,000. So that made a huge impact on people that were in high income tax states like California and New York. Because think about it, I've worked with people that have easy, $60, $70, $80,000 in state and local tax. That's a huge deduction from your federal, right? So to be capped at $10,000 was a big hit on the tax side. So the new One Big Beautiful Bill Act changes that up until 2030. It raises the deduction for the state and local tax up to $40,000, and it reverts back to $10,000 in 2030. There are some income limitations to be aware of. So after $500,000, it starts phasing out. And for a couple, if you're married filing separate, it's $250,000. So if you make over those amounts, then you start getting a hit reverting back towards the $10,000 mark. So something to keep in mind, right? So some people, unfortunately, and fortunately, in some ways, right, they're making lots of money, like over $500,000. And unfortunately, on the tax side, they still are at the $10,000 limitation for state and local. But most people that make under those amounts, and they can take advantage of the state and local tax. So that's a huge impact. And it's a great planning opportunity because maybe you're due a bigger refund now as a result. And then this is something that you should speak to your advisor about to say, if I'm getting a much larger refund, does it make sense for me to adjust my withholding to then have more money available to me during the year that I can use that for saving and investing or any other project? Now, you have to be careful with that, right? Because you also don't want to under withhold. So you want to work with someone that knows what they're doing. The IRS charges penalties if you don't withhold enough income taxes during the year. So you have to be aware of that as well, right? But if you can find that sweet spot where you can lower your withholding and still cover your minimum liability so that you do not incur any penalties, it may make sense, right? So speak to your financial planner or your tax professional about that particular strategy. Mortgage interest deduction. So if your mortgage balance is $750,000 or less, and you use that loan to buy, build, or improve your residence, you can deduct that interest, right? After $750,000, there is a calculation that needs to be done. It starts getting lowered, right? It's prorated. Now, here's a big change for 2026. Mortgage insurance is tax deductible. And what I mean by mortgage insurance is not the insurance that you use to insure your home. This is also known as PMI, so private mortgage insurance, or MIP if you have an FHA loan, which is mortgage insurance premium. This is typically something that your lender requires for anyone who puts less than 20% down on a home when you first buy it. Or if you refinance and the loan balance is higher than 80% of the value of the home, you would pay a PMI. So if you have that PMI, you can now start deducting the premiums. There are income phase outs to be on the lookout for. So it's $100,000 for married filing jointly and $50,000 if married filing separate. But let's say if you're married filing joint and you make $100,000 or less, you can deduct your PMI premiums. And this is important too, especially if you're thinking about buying a house. One thing I always tell people to figure out or work with someone that can help them figure out is what is the tax equivalent of owning a home, because compared to renting, because you have your rent and typically your mortgage would be higher. But if owning a home makes you be able to itemize your deductions, because now you have property taxes and you have mortgage interest, you may have PMI, you have to see how much in taxes you're saving as a result. Just so that you can have a true comparison. Obviously, homeownership comes with other costs involved, right? Insurance and repairs and unexpected repairs, especially, could be devastating. But just something to think about that from a tax perspective, there could be some benefits there. And you can use those to compare to the rent to see how much different it is. Also, qualified business income, also known as QBI. These are things that are available to even sole proprietors, partnerships, and S corps. So you can deduct up to 20% of the lesser of your qualified business income or your total taxable income, subtracting capital gains. So that is great for even people that are self-employed, that sometimes don't consider themselves self-employed. So even if you drive an Uber or you have a side hustle, you sell stuff online, you are still technically, for that income, considered self-employed. So when you do your taxes, you could deduct up to 20%, right, of your qualified business income. So that is another deduction, and this is on top of your standard and or itemized deduction. So that could be a big change for you, something to be on the lookout for, especially if you start in a business this year. And there's also a new minimum deduction of $400 for those that have at least $1,000 of qualified business income. You get that like floor $400 deduction if you have $1,000 minimum, right? So that's another change that happens this year. Okay, so now let's talk about these temporary tax breaks. And I'm going to tell you how they work and also how long they're here for. 3 breaks or 4 that you might have heard about, which are here to stay as of now from 2025 to 2028 tax years. The first one is enhanced senior deduction. You may have heard about it as no taxes on Social Security, but that is not exactly accurate. Most people, if they're retired and their only source of income is Social Security, you're probably not going to pay any income tax. But you do pay taxes on your Social Security based on your filing status and your income. If you make over a certain amount and you have revenue from like interest, a pension, things like that, it could trigger taxation on your Social Security income all the way up to 85% of your Social Security income could potentially be taxable. So before, it was advertised as no taxes on Social Security. So some people got confused with that because it's not the case. What this bill created was a $6,000 deduction for each senior that may be claimed if you're 65 or older, and this could be up to $12,000 per couple, in addition to the standard deduction and any other current age-based deduction that you can get. So this is great news still for seniors, right? So a couple that is 65 plus, married, filing jointly, has now an additional $12,000 that they can deduct. And remember, it's a deduction. It's not that they're getting $12,000. They're just paying $12,000 taxes on $12,000 less, right? Which creates additional tax savings, right? So 6,000 individual, 12,000 couples married, filing jointly. One thing to note is that you have to be filing a joint return if you are married. So if you are a senior or your parents, someone you know that's 65 or older, if they're legally married and they're filing a separate return, they're not eligible. They are not eligible for this $6,000. So something to consider as well. You know, I often get questions as far as like, oh, is it better to file jointly versus separate? Most of the time, from my experience, it makes sense to do jointly if you're married. There are specific situations where it makes sense to do a filing separate, but that's something you definitely want to speak to your tax professional about because it's very specific to your situation. But I'll give you one example that comes to mind. Yeah, I have clients that are in a income-based repayment program with their student loans, and they are applying for loan forgiveness. So currently, they might work at an eligible institution that allows them to eventually get public service loan forgiveness after 120 payments. So the idea is they want to make the smallest amount of student loan payment to then ask for student loan forgiveness later. If you're married and you file jointly, the income-based repayment program uses the combined household income. But if you're married filing separate, you can use just your income and not your spouse. So I have some clients that are in that situation and they file a married filing separate return. They may get not as much of a benefit tax-wise, but the benefit that they're getting on the student loan side outweighs the savings that they're not getting by splitting, right? So these are the kinds of things that you want to work with somebody and see what is in your best interest. All right, another temporary deduction is the no taxes on tips. And that is basically up to $25,000 for all fighting statuses, except for married filing separate. So you do get a penalty here again. If you're married and you file a separate return, you cannot deduct the tips. So up to $25,000 of eligible tips could now be deducted from your income. So just to give you an example, if you made $100,000 and $25,000 of that was in tips, you can deduct that from your income and only pay taxes on $75,000, right? So remember, it's a deduction. It's not like you're getting money back. It's just giving you tax savings. One change that I wanted to point out also before we move on to the other temporary deduction is charitable deductions. So remember, those that have enough combined deductions can itemize. Charitable deductions now have a floor of 0.5% of adjusted gross income starting in 2026. So if you donate $10,000, for example, the first 0.5%, in this case, $50, cannot be deducted. Only that difference could then be used as an itemized deduction. So something to keep in mind. However, there is good news. Even if you do not itemize, you can now deduct $1,000 if you're single and up to $2,000 if you're joint. And this is what's called above the line, meaning that you don't have to itemize. So now keep track of your donations. And these are cash donations, right? So keep track of your donations throughout the year. Before, you may have not paid attention to it because you couldn't deduct them anyway if you were just taking the standard deduction. But starting in 2026, you have that $1,000 if you're single, $2,000 if you're married filing jointly, right? So donations to charitable entities like church and so on, make sure that you keep track of those because now you may have an additional deduction that you were not able to take advantage of in the past. Also, another temporary break is a deduction for overtime. Similar to tips, it's up to $25,000. However, one key difference here is that if you are single, it's only $12,500. So remember, this is again a deduction. So if you have overtime income up to $25,000 as a married couple filing jointly, you can deduct that from your income. However, one thing to keep in mind is that the overtime premium is what's eligible, not the entire amount. So what I mean by that is, let's say, for example, you get time and a half, you get $50 an hour. One half of $50 is 25, so you will get $75, right? 1.5 times for your overtime hours. Only that additional $25, that premium, is eligible for the deduction. So one thing to consider here is that a lot of employers were not ready to implement this. So you may not have a W-2 that shows your overtime premium on box 14. So I just want to make sure you didn't miss out on that. If you worked overtime and you already filed the 2025 tax return, just make sure that you included the overtime premium. Most of the time, just provide like the most recent paycheck, the last one in 2025 to your tax preparer, so that at least they can look for how much you had in overtime. And then they can include it in your taxes. Going forward, most likely, I already started seeing it with a lot of W-2s. It'll be included in box 14, so it'll be very easy to keep track of. Another thing here for both the overtime and the tips, it phases out after $150,000 if you're single and $300,000 if you're a couple that is married filing jointly. And again, here you get penalized for married filing separate. So you do not get to take this deduction if you're married and you file a married filing separate return. All right. Another one that was a temporary break from 2025 to 2028 was the car loan interest deduction. So you can deduct up to $10,000 in interest on any vehicle purchase that was assembled in the United States. So that's one thing you have to look into, make sure that your vehicle was, in fact, assembled in the United States. There are some income limits. So it's $100,000 for single and $200,000 if you're married filing jointly. So that one is probably one of the ones that's hardest to get, because for you to get $10,000 in interest, you probably have to buy a very expensive car. And if you're buying such an expensive car, then you might be making over the income limits anyway, hopefully. So something to keep in mind. Most likely you will receive a 1099 from your lender that would show how much interest you pay. And remember, this is not the car payments that you're deducting, it's only the interest portion all the way up to $10,000. So something to keep in mind. All right. And here's another one: tax favored accounts for newborns, AKA Trump accounts. These accounts are new, starting this year. And one thing is, they're basically like a retirement account for children. So any child that is born in the United States that has a valid Social Security number, you can open the account for anywhere between birth and up to 18 years. You can put up to $5,000 that could be contributed. When they turn 18, this money is theirs. So one thing for you to consider, the money grows tax deferred, and then it could be used for things like education and so on, but you'll pay taxes on that money when you take it out. Now, it could also be funded on behalf of the individual, and employers can provide matching contributions subject to $2,500 annual cap. I haven't seen any employer do that yet. Maybe that's something, because they're new, right? But probably we'll start seeing that next year. Now, another key thing for this is that parents of children that were born between 2025 and 2028 get a free $1,000 seed contribution from the government. Now, how do you get this? If you file your taxes, you can claim this on IRS Form 4547. So, something that your tax preparer would do if you prepare your own returns. Here's a form number 4547. That's one way of getting it. If you already filed your taxes and you forgot to include this for your baby, that's okay. You can go to trumpaccounts.gov and and enter all your information. The accounts will go live on the 4th of July. If not, you could just do it on your taxes. So remember Form 4547. So any child that was born between 25 and 2028, you can get that free $1,000. So I would say, even if you don't plan on contributing to this account, why not get the free $1,000, right? It's free money. So might as well just get it. And talk to your financial advisor about this, because if you plan on contributing to this account, you have to compare this to other types of accounts that you could open for your children. For example, a 529. If the money is for school, you want to compare the two, because there's limits, right? There's taxes. Like, what has the most benefits? Is a 529 better than the Trump account, right? These are the kinds of things you have to think about. But for now, I would say if you had a child between 2025 and up to 2028, get your free $1,000. And I'll put the link in the notes as well so that you have it. So these are some of the key highlights that I feel like most people will encounter day to day, and are probably going to affect your taxes one way or the other. So that's pretty much it. If you have any questions, as always, you can send me an email, luis@buildabetterfinancialfuture.com. And as a reminder, I have the ultimate guide to taxes for 2026. Do some tax planning. Tax planning is a year-round sport. Just visit the website, buildabetterfinancialfuture.com, so that you can download your free guide. As always, thank you for tuning in, and I'll see you on the next episode.
Thank you for listening to the Build a Better Financial Future podcast. If you enjoyed the episode, please remember to subscribe and share it with someone who could benefit. To learn more or connect with us, visit buildabetterfinancialfuture.com. This podcast is for informational purposes only and does not constitute financial, legal, or tax advice. Please consult with your own professionals before making any financial decisions.